Today, folks, I am going to unequivocally share with you where the market is growing, where the market is dying, why I'm still bearish. This market crash might not be over yet. And don't get me wrong, I am all in this market. I cost average into this market. I will benefit if it goes up, but you can't help but not understand the fundamentals are still deteriorating and they're not growing. It perplexes me that YouTubers and TikTokers are so damn bullish on this market rally. And I'm hearing big YouTubers being like, oh, the layoffs are going to lead to extra cash flow. The market's going to boom. Buy now. It's like, when was that ever a bullish statement? Because companies are doing layoffs, because inflation is cooling down. Maybe speculatively they might cut rates. Another reason for the markets to go up, but none of that has to do with actual business fundamentals. When did this stuff ever become the reality of why you should buy stocks? I will never know. And again, I'm all in this, baby. I'm in this market. I make money, it goes up. I lose money, it goes down. I'll always be buying because it's all pure fugazi. It's all delusional insanity. So we're going to be taking a look at the stocks that people just love. NASDAQ stocks, like QQQ top 10 holdings. We'll talk about some of the ARK innovation ETFs. People love pumping a lot of these companies right now. Shopify. We'll talk a little bit about perhaps Palantire, I know, is in here. Tesla, all these great companies. Zoom. We'll get into some of the gambling stocks. We'll take a good zoom through the obvious S&P top 10 companies, a little bit of Berkshire in there, your meta stocks, some of the oil companies. I think this is going to share some light into what is actually fundamentally happening in this macro environment, and it's all related to damn revenues. Nobody ever just seems to talk about revenues or growth. They're just like, delusional, macro, oh God, the Fed. It's like, I don't care about that. It's like Warren Buffett says. It's like, I only really care about what the company's doing. Are they making money or are they losing money? Are they trading at a wicked high value and they're not growing? That's the concerns you should have. Take a look at Apple here, because if you ever told me for the first time Apple would be showing negative revenue growth, if the stock would be holding its all-time highs, I wouldn't believe you. People were shorting Apple, speculating on earnings that iPhone sales would slow down. And here we are. We're finally in that moment where it makes sense to short it, and the stock is flying. And don't get me wrong, I love Apple. It's one of my favorite companies. I always believe in long-term investing, but in the macro aspect of things, this is the first time we've seen some pretty big dips in revenue growth going back to 2019. Which again, quite concerning. I mean, if this consists, right, if it continues, the stock can't keep going up when there's nowhere to make extra earnings from, right? Unless you do layoffs, unless you just fight to get margins up. That's what companies are doing right now, but that is a band-aid in a short period of time to make numbers look slightly better. Here's Microsoft. Microsoft's still one of my favorite companies as well. And again, it's not looking too great. We got finally a little bit of growth coming back, 10% revenue growth, but we're not going back to these all-time highs here. Things are really starting to level off with the two mega caps holding up pretty much the entire S&P, the Qs. I mean, there's a small handful of companies. NVIDIA is one of them right now, and NVIDIA really perplexes me. That's going to be the word of the delusional perplexation, if that makes any sense. Look at NVIDIA, though. This company is skyrocketing on AI, which, again, seems to be like another intriguing aspect of the market that I see has long-term prospects, but people are letting it run away with them. Maybe look for AI stocks that are a little less overwhelmed, because I still think NVIDIA could be a little bit of an overshoot at this point, considering the revenues have dropped off 20% in the last quarter. Amazon's still pretty unique here in and of itself. It's one of these companies that hasn't showed negative revenue growth in over a decade now. You can clearly see the economy slowdown period here. I mean, the revenue growth has fallen off a cliff, and again, the revenue growth on a percentage is down at the bottom here, and you can see the total numbers over a 12-month trailing at the top, and yeah, they're still growing. They're still growing nicely. So if they could ever start pulling EPS or margin from their bottom line, I mean, I could see Amazon stock exploding, but they'll never do that. So with Amazon, you can only ever pay attention to the revenue. Now, on the marketing side of things, it's a bit sketchy here, right? Now, I love my YouTube, Google. I think YouTube's one of the most profound platforms of our generation. And obviously, if you're a YouTuber, they're cutting our ad spend. We're not getting nearly as much ad revenue as we used to. Every YouTuber's complaining about it, and especially in the finance space, they really point that out. But, Google's done a pretty good job at staying above revenue growth. Like, they're still just slightly kicking all-time highs. Their margins getting eaten up. Their bottom line EPS slow down a bit. But like I said, EPS is playable. Margins are playable. Some things are going to affect it. But so long as revenue keeps growing, this is a sign of a healthy functioning machine to me. In a really bad economic time, if you're still posting positive revenue growth, maybe it's not all that bad, right? So here's Meta stock. This one, Meta stock is funny, man. I sold that at 220, somewhere in the mid 220s. This thing went all the way down to 90. If I was smart, I should have just cost average, because here we are at like 240, 250. I would actually be green right now, especially if I cost average. But again, on a fundamental basis, it's just hard to wrap your head around how this company continues to go up. Now I still got exposure. My fiance still holds a lot of these companies on an individual basis. Obviously, I'm buying them when I'm buying the S&P 500. I'm still cost averaging on all of these, but again, from a macro level here, Facebook over the last decade, for the first time in literally over a decade, is showing negative growth from a revenue standpoint. Now, let's talk about Tesla from, this growth beast perspective. The company that has captured the eye of the entire globe is still able to grow. And again, we're seeing this slowing growth. We're kind of going back to the 2020 level during the pandemic, but we're at about 24% revenue growth. If it stays in the mid 20s, I mean, that's pretty exceptional in a recessionary environment, considering how much people do not buy cars in moments like this, especially in a higher interest rate environment where it's just exceptionally hard to get borrowed cash. And it's kind of incredible to think you borrow cash from the bank, you buy a Tesla, and that hits their bottom line. And so it's incredible how much debt actually fuels a lot of this revenue growth, and we're going to see that continue to be taken away, right? But incomparable, look at GM. GM's only growing at 11% clip, but is still actually holding some revenue growth in this weird macro environment. Actually, I'm really impressed with the auto companies compared to even some of these tech giants, because over the last couple quarters, like look at Ford here, showing 25% revenue growth. Obviously, these are not all-time high numbers. Now, I'd have to double check these numbers because they almost seem not real to me. Maybe I have to do a little deep diving, make sure macro trends here. I really love macro trends. They do a great job of bringing this data into one place to make sure it's accurate. But if it is accurate, this next stock is going to blow your mind. And that, of course, is Berkshire Hathaway. Oh my God. This is something that I've underlooked, and I've been thinking about buying this. So I've been trying to compile a list of growth stocks that I really want, because I do want to get back into individual growth plays, and I'm hoping we see somewhat of a pullback. And I've been looking at things like Shopify because I think it's Canada's greatest growth company, and I've always wanted to own it. I even think at this price, it's something that would be worth perhaps cost averaging into. We'll talk about Shopify in a moment. I've been talking about things like Tesla. I really want to get Tesla back in my portfolio. Like I said, I'm not trusting this macro environment. It could run up. I don't really care. I'm not missing out here if it keeps running, because I'm not putting like exceptional amounts of money into it. I'm primarily an index guy at this point, right? But take a look at Berkshire. I mean, I don't think people understand at what a discount Berkshire's trading at, because this company grew at 20% revenue growth for the first quarter of this year. We're talking about Tesla level growth here, and nobody talks about it. Berkshire is a company that I've been debating on buying a lot, and I think it would be great again, it's almost like buying an index. It gives me some global diversification, some management. It kind of reminds me of some of these like dividend ETFs I'm buying, but it's like the exact opposite. They're managing the dividends for me. They're not paying out that cash flow, but you can't help but be astounded that this company is posting this kind of revenue growth. And I think it's largely overlooked. No one talks about it. And that's kind of what I love right now is stocks no one's talking about. Because when everyone and their grandmother's kind of piling into things, it gets a little concerning. Oil obviously is turning back the other direction here, and that's another concern too. Berkshire's kind of oil concentrated now. Not that it's affecting them, because obviously they're so well diversified at this point. It's probably a small percentage of the portfolio overall. But nonetheless, oil, obviously, as oil prices have come back, we're going to continue to see this kind of decline in oil revenue. So when it comes to Exxon and these big oil companies, now is not the time to be bullish for as long as we're seeing a decline in the total oil prices. But let's pivot one more time, and then we'll talk about some of these mega growth stocks that Kathy has in her portfolio. But I can't help but point out some of these consumer staples, because I'm kind of blown away that even Pepsi, is still growing in a double-digit revenue base here. We're at 10%, right? Wow, man, Pepsi. I've looked at things like Procter & Gamble. They're not doing as exceptional as Pepsi is, and I couldn't figure out why Pepsi's trading at such a high premium. But I mean, this is why. This is why Pepsi's just holding tried and true and continuing to prove resilient, right? So on the Palantire side of things, I know this is a favorite right now. It's probably one of the underrated AI plays. It hasn't seen the same momentum as many of the AI companies. Today it's flying. It continues to kind of pick up momentum here, and it kind of, again, I always get a little concerned that the more momentum it picks up, the more hype you hear in the community, and everyone of the grandmothers talking about it, which again leads to some of that concern of, is now the right time to buy it, considering, again, this company isn't growing at the peaks it was, but we're talking about a company that is generating, getting into the $1 billion of revenue generation, right? But again, we're not seeing the same kind of growth we're getting out of a company like Tesla, even at that scale. So for a software company, right, it'd be nice to see a little more revenue growth for a smaller company. I mean, if you're smaller, you're in the software side of things, you'd expect a little bit more revenue growth. But again, slowing environment. This company, I think, more or less caters to governments, large businesses. And again, I don't know what this could just be a sign of that, what businesses are focusing on the macro aspect of the environment. But again, who knows what the long term looks like here? Could be a good buying opportunity if you're a long term perspective. But we'll see what the hype leads to in the next couple days. Here we obviously got Shopify, right? Now Shopify, again, here's a software company generating quite a decent amount of cash, but we're talking about 25% revenue growth as it comes back after the layoffs. So if they can keep up this 20% clip on the revenue side, they're not showing real EPS growth. Everyone focuses on EPS. But again, this is why I think Shopify is a good player here. It's one of these only companies that still hasn't posted any negative revenue growth, which again makes it an intriguing play, right? Again, I try not to focus on growth companies like this from an EPS standpoint. If the revenue keeps on this pace, it's hard not to want to buy it, which is why it's one of these companies I'd love to perhaps start cost averaging into in my portfolio as it begins to dip. Again, I want to know what you guys think I should be buying here. You think I should be buying a company like Shopify or Palantire, Tesla, Berkshire? I'd love to know what you think. I really want a small handful of companies to just start focusing on in this macro, kind of crashing environment, because I think this is where the opportunities are, especially how low Shopify is right now. This is that opportunity that's opening up. Look at Zoom. So another Kathy Wood favorite here. For this to be such a smaller company, again, from a software side of things, I'm really shocked that their revenue growth has dropped down to 4.39%. Again, no negative, but they're really hovering on that line of, people just don't, and I use Zoom to make these videos for you guys. I'm not paying for the premium. I don't pay Zoom anything, but I don't know how they can get that revenue up. I just don't see how they do it, and it's really reflecting on that growth. I'm going to finish up with two more really intriguing ones. From the crypto side of things, Coinbase. Crypto, if you don't believe crypto's dead, I know there's still you get all these, Michael Saylor, those guys that are still pumping it to the moon. I have crypto exposure still. ShakePay, I love that free crypto app here in Canada that never went bust. They stopped doing all their promotions. There's no way to make really good Bitcoin. There's no real API returns or interest rates on them anymore. NFTs are completely bust. All the speculative bubble bursted, and this was like the darling child of the speculative market. Now, again, if you're into crypto, I think speculating, so long as you understand that you're purely speculating, there's nothing wrong with throwing any more than you throw at a casino, right? So me and my fiance, we've got maybe $500 something, probably a little more than that now that crypto's rallied in crypto between Ethereum, Bitcoin. I just don't talk about it because I've noticed the scammers have dispersed from my comment section below ever since I stopped talking about crypto. So I just try to avoid it because I do like reading your comments. And then finally, the gambling side of things. In a market environment like this, I think people just having maybe depression, I don't know what it is, but I hear this a lot, even from Caleb Hammer, this new YouTuber. I mean, his channel's exploded, and I've seen some gambling addicts on there, and you kind of see how it comes out of people when they get in shitty situations, and they see this as like an imaginary escape where they're like, if I could just win a lot of money, I can get out of here. And DraftKings, this is, again, a Kathy Wood favorite, and I think there's some real opportunity in the gambling sector of the market because, man, not the casinos. There's no money, I think, in casinos. They're very cyclical in recessionary environments. But this online gambling stuff, like these pure online plays, look at the growth here. 84% for Q1 of 2023. DraftKings could be a real opportunity, I think. Not DraftKings particularly. There's other ones that I like more. In the UK, there's some other globalized, online gambling companies, and they do have regulatory risk. But again, this sector of the market is excelling in a recessionary environment, which is kind of counterintuitive. You wouldn't think people had money to gamble, but clearly people gamble more when they're concerned about their money. Very psychological event there. But these are the aspects of the market that I find so intriguing that large caps, again, aren't seeing the revenue growth that inspires this insane market rally from the NASDAQ and all this stuff, which just, again, concerns me a little bit. Impressive to see Berkshire where it's sitting today, and I hope this offered some insight beyond just looking at a stock price. But I'd love to know what you think in that comment section below.